Welcome back, ladies and gentlemen. My name is Arya. I don't waste your time, so let's get straight into it. In today's video, we're going to go over a company which I've become increasingly interested in and perhaps making a purchase decision and adding it to the portfolio because I think it complements a position which I already have in the portfolio. ASML is a company that I invested in the fall of 2023, and I'm sitting on massive gains, hence why it's not a bigger position for me. But ASML, of course, being the massive lithography giant that makes the machines that end up making the chips for like literally everything, your car, your phone, laptop, iPad, everything, right? So they make these massive big lithography machines, and these are what print on top of the silicone wafers or whatever they're called, and they actually make the semiconductors, right? So ASML sells to TSMC, Intel, Samsung, so on and so forth. But ASML is not the highlight of today's video. Instead, we're going to be talking about a company which is similar. It makes equipment as well, and it sells it to all these different foundries. But instead of making lithography equipment, they make what's called optical inspection machines. And what optical inspection machines do is they essentially quality check the chips coming out. And they make sure that the chips don't have any defects, and they're also being churned out at a very rapid and efficient pace. So in today's video, we're going to go over what these machines are, and we're going to go over the qualitative aspect of things with KLA Corp. And as always, we're going to jump over to my spreadsheet to look at the valuation to see where it stacks up against other investments that you could be making today. With that being said, let's jump all the way over to the demo that KLA Corp themselves, this is on their YouTube channel, they did for us. So we're going to have them explain what the machines are just because I'm not no professional. Yeah, let's take a peek at what they have to say.
Today's digital world is powered by advanced technology chips. To move technology forward, chip design nodes continue to shrink and structures are going vertical. These advances bring integration challenges requiring new defect discovery solutions. There are three critical inspection challenges that must be addressed: detecting defects at the bottom of deep holes and trenches, finding sub-5 nanometer patterning defects, and maximizing sensitivity while maintaining throughput for wafer coverage. Our revolutionary...
So they said it there, and these are the optical inspection machines right here, right? So they just check for defects. They make sure that they don't have holes, that they don't have bumps in them, that there's nothing wrong with them, they're good to go. And there's a terminology in the chip industry known as yield, and yield is essentially how many chips are defects per X amount, right? So if there's like 1,000 chips throughput coming in per, I don't know, 10 minutes or whatever, they could check, be like, oh, okay, realistically, it should be less than 5 chips that are damaged or whatever per 1,000 that's coming in this time frame, whatever the case is, right? And they could look at that yield, and they're able to detect these defects, and from there they could make decisions and try to improve the yield of the production line.
E-beam inspection system, the ESL10, has the innovative technologies to address these challenges. The ESL10's electron optics have a wide operating range. With the maximum landing energy of 30 kilovolts, electrons reach the bottom of deep structures. The high-energy backscattered electrons are then collected by the unique in-lens detector, enabling signals to defects at the bottom of deep structures. 6 channels work simultaneously to collect various signal types from defects. The signal collected from secondary electrons provide...
So I'm going to pause it again right here, but as you can see with that one thing that they had back here, they kind of shine this beam of light, right? So they shine this beam of light down through like you could see just like the massive boards, right? So they can check all over this to ensure that there isn't any defects. And skipping over a little bit here, this is, yeah. So long story short, they shine this beam and then they could check for defects on the chip, right? That's essentially what they do. Again, this is just some like next level science stuff that's going on here. So I haven't fully delve into exactly how these machines work. Long story short, they check for defects. That's all we need to know as investors. So anyways, the massive specialization that KLA does, which is of course these inspection machines that we've been talking about all video long, they have roughly a 60% market share. So the tweet I made back here, this 90% market share, I think it's for a different part of the business, but the main revenue segment of the business is in fact this inspection and metrology equipment that they make, and they have 60% market share in that respective part of their business. Moving on, I wanted to go through the investor presentation. There's a couple key things that I wanted to point out. The main thing is like literally the first slide they show us. This goes back to the whole market share thing, right? And they tell us that they have roughly, again, like a 8% market share, whatever it is. And that's 4 times larger than the nearest competitor, which lines up with this over here, this chart that we pulled from the Seeking Alpha article. At 12%, roughly 4 times, that's about 50% market share for Applied Materials if you were to times it by 4, right? So yeah, more than 4 times the market share of the nearest competitor, which is Applied Materials. That's a very interesting business, by the way. We might do a video on that later on. But anyways, in 2023, Klac maintained 85% market share in critical markets for optical inspection and unpatterned inspection, 66% market share. So the two main business lines that Klac has, 85% market share, 66% market share. As you see, they're very specialized into this specific part of the wafer fabrication equipment business, and they just have massive market shares. Over here, they talk a little bit about the revenues, gross margins, operating margins. This business has incredible margins, and it makes sense based on the structure in which the whole just fabrication and foundry business has gone on in the future. I'm going to link this in the description as well. This is a podcast that I listen to. But long story short, there's like a mutual understanding between the customers and the suppliers of like, yeah, we're going to charge a pretty handsome fee to like get this done for you, like give you these equipment because we put a lot of effort into building them, right? The guy in this podcast here explains it better, but to give you an idea like that, that's kind of the mutual understanding that all these different businesses have with each other. Hence why the incredible margins, right? And I think they have the highest margins gross margins between TSMC, ASML, Fab 5, like all the different businesses engaged in this subset of the chip industry. They have the highest gross margins, if I'm not wrong. This company has incredible management. Over here, you can see in 2022 when the stock tanked, so did the entire chip sector. But when the stock was incredibly cheap, they were actually able to buy back a ton of shares. And this has been incredibly value accretive because they bought them at roughly $300 a share. The share price today is trading at roughly $750. So incredibly accretive share repurchases made by the management team. Kudos to you guys. And dividend compound annual growth rate of 15% since the year 2006. Absolutely incredible. And over here at the bottom, they have a slide here where they talk about how, right here, committed to long-term 85% free cash flow return to shareholders through dividends and share repurchases. So in the long term, they want to return back 85% of free cash flow, and this is a highly free cash flow generative business back to the shareholders. So you guys might be thinking, oh yeah, that's great. This is a business that qualitatively checks all the boxes. It seems they're very entrenched with their machines. It seems like these are very complex machines that they're actually building. But Arya, what about the fundamentals of the business? Now, of course, as you know, I'm a fundamentals first investor, and that definitely also checks the box because I wouldn't be making a video on it. Return on tangible assets. Similar to ROCE, but more focused on, let's just take a specific look at the tangible assets of the business. So like the physical things such as like your factories, your office buildings, company trucks, all that type of stuff. Let's not include intangibles such as brand or such if you have like an insurance thing, like prepaid insurance for a year or whatever the case is, that's also considered as an intangible asset. All these different things, right? Return on tangible assets of this business is 143%. Is the ROIC and the ROCE, they also don't lack. They're roughly in the 30% range. To give you an idea, the average of the S&P is roughly about 15%. So this is easily more than double that. And if you were to actually chart this, you would see that it's growing over time. Moving on, of course, we briefly touched on the margins of the business. You're looking at 60% gross margins, 36% operating margins. And gross margins, of course, if you didn't know, 60% means that they buy things on average for $4 and sell them for $10. And it's much better to buy something for $4 and sell it for $10 than if you were to buy it for $8 and sell it for $10, right? Just plain math. Again, to give you an idea, the average of the S&P is about 35%. Operating margins 36%, average of the S&P roughly about 10%. So again, margins-wise, incredibly stellar business. And what about valuation, Arya? I hear you. And again, it wouldn't be a video of mine if we didn't go over the valuation. Valuation is something that is a little bit more concerning, not necessarily because the valuation at an absolute level is high. It's more so that this company has historically traded at much cheaper prices. If we just zoom out to the past 10 years, you would see that in the past 10 years, you're buying into a valuation in this company that is an all-time high in the past 10 years, right? It's never been more expensive. Again, valuation-wise, that the amount of cash flow you're getting per share, this is the most expensive it's ever been. And if we were to scroll down here on finance charts, not sponsored, but if we were to scroll down here, you would see that when they average it out as well, you could see that progressively this company has had their multiple expand over the years. In the past trailing 12 months, you could have bought, if you just at any point bought shares of this business, you're buying it at an average of 26 times cash flow. Today, you're buying at roughly 33.5, right? I think that lands it at roughly a 3% free cash flow yield. So the stock has ran a little bit, And it's not necessarily because the fundamentals have improved. Instead, it's more so that the stock has ran because investors are placing a higher bid on the cash flows that this company is able to produce over the past roughly year to, year and a half-ish, right? The rebound that we've gotten because of NVIDIA, so on and so forth. Moving on, I'm going to just quickly mention this absolute beautiful human being, the chip investor, the chip stock investor. I'm going to leave some of the videos that he made on KLA and some of the other businesses in the description below. Absolutely amazing information that they were able to share on KLA, Applied Materials, so on and so forth. Same thing goes about the podcast. These were resources that helped me out a lot in researching this video. Moving on, at last, we're going to look at the valuation in reference to other companies in my investable universe. I include this spreadsheet that I made myself in every single one of my videos. Long story short, we take the current valuation of the company and we divide that by the amount that we expect the company to grow by. So, for example, just to give you an idea, we got KLA Corp here, and roughly, we just looked at it, it's roughly trading at a 34 times price to free cash flow multiple, and I just put in as an arbitrary number just so we have something to compare to the other companies, I put a 15% free cash flow compound annual growth rate. So we take 34, divide it by 15, and you land at a 2.26 times multiple. And then of course, as you can see, I put all the different companies in my investable universe next to each other. You would see that a company like Synopsys, which of course makes the EDA design software, they are trading most expensive relative to how much growth you're getting. A company like Evolution Gaming or Ulta Beauty is trading most cheap for the amount of growth that you're getting. Of course, this isn't absolute. This isn't green, we have to go buy it, red, avoid it at all costs. You would notice that the S&P 500 is actually in the red here, but this is more of just to give you an idea of how much growth you're getting per share. And of course, the caveat is that, for example, a company such as Moody's or S&P, which trade more expensively, those businesses have a much longer runway of growth. So maybe you should take that into consideration. These are businesses that I might own for, 10, 20, 30, 40 years, right? Compared to something like Ulta Beauty, which is a retailer that, might not have that durable of a moat for that long of a time period. So to recap, KLA here at 2.26 is roughly fair valued. So they're not particularly expensive, and at the same time, they're not too cheap where it's like a screaming buy, pound the table, we have to go get shares now. And this is what kind of really stopped me from making an investment decision. Just the valuation is just a little bit higher than where I'd like it. I have other opportunities which I like a little bit more. Even MSCI, after the stocks ran quite a bit, after I did buy this one at 460, put out a video on that, I'll put it in the show note in the corner. But yeah, there's other companies in my investable universe that are trading cheaper that I understand better. That's another important thing. I don't understand this business too well. So me personally, I think I'm going to hold off with this one for now. I'm going to do a little bit more research, try to really get the ins and outs of how the machines work, how the relationships with all the different foundries work and all that type of stuff. I think quality-wise, this company more than checks the box. So with that being said, I'm going to hold off on this one for now. One last thing before I let you go, I want to ask you to do something that costs you nothing, but would help me out greatly. If you could hit that subscribe button, I'm going to continue to post high-quality videos just like this one. And if you ever decide that you don't like the videos, you could always go back on that decision, but I highly doubt that. Thank you for watching. Have a great day.